What's up, traders? Today we're going to be talking about Fibonacci. All right, what is Fibonacci? What are Fibonacci retracements? What are Fibonacci extensions? Okay, so just a little backstory on Fibonacci. I've pulled up this web page. Fibonacci was an Italian mathematician, and what he did was he basically had what were called Fibonacci numbers, and it's something that he noticed that happened everywhere in nature, whether it was seashells or this is like the Nautilus shell, and each of these, um, different sections are actually in perfect sequence of Fibonacci numbers. So the Fibonacci numbers are 0, 1, 1, 2, 3, 5, 8, 13, 21, and it goes on forever. And the way that's figured out is you take the first and the second number, you add them, and then it makes the third number. So if you look, 0 plus 1 equals 1, 1 plus 1 equals 2, 2 plus 1 equals 3, 2 plus 3 equals 5, 3 plus 5 equals 8, 5 plus 8 equals 13, and so on. And that goes on forever. And what he noticed was in nature, in life, that anything that expands or grows in nature or life grows according to this sequence. So he started noticing it in flowers, in animals, the way that animals mate. Rabbits. They have a little diagram up here when rabbits mate. And at the end of the first month, there's only one pair. At the end of the second month, they produce a new pair, and so on. And before you know it, it goes in Fibonacci numbers: 1, 1, 2, 3, 5, and then obviously the next one you can guess would be eight pairs. So um, this happens in nature, obviously happens in plants and all these different things. And to no one's surprise, it happens in the markets. So how do you use Fibonacci in the markets? How can you use Fibonacci to help predict where you can enter and exit the market in order to make money? Well, we have something for free. It's pretty much on every platform. It's a basic tool, but it's definitely something that you can use in an advanced way when you have a fib retracement. All right. So what you do is um, you draw. What you're going to do is you're going to draw from swing high to swing low, or swing low to swing high, depending on what kind of trend you're drawing. So what the Fibonacci tool is measuring is retracement. So in a trend, we have our impulse leg, and then we have a retracement in an uptrend, and then we have another impulse leg, and we have a retracement. Okay. So what you're doing is if you saw that price is moving up and you want to get in on an uptrend, but currently price is retracing, you don't want to enter price. Um, let's say here, that's black. Let me change the color of that. Right, you don't want to enter price, like let's say price is moving up. You don't want to just buy here because guess what? There might be a retracement, and then you're going to be negative before you're positive. You know what I'm saying? So what you want to do is buy on a retracement as price is moving down. So price moves up and it goes down. You want to buy somewhere around here so that once you buy, price moves up again. And how do you know where price is going to turn around at? Well, as we've talked about in other lessons, support and resistance, as you'll learn in supply and demand, different things like that. There's different tools you can use, trend lines. There's all these different tools you can use to learn or to predict or have with decide with great probability where the market may turn around at. So Fibonacci, what you're going to do is in an uptrend, all you do is you measure from the first point to the second point, right? So in a here's a downtrend right here. You have impulse, retracement, impulse, right? Retracement. So in an uptrend, you're going to measure the first point, which is the low. So you're going to measure from swing low to swing high, and then drag it out sideways, right? That's how you do that. Now, each of these levels is a Fibonacci retracement number. So this is 38.2, 50%, 61.8%, 78.6%, 88.6%, and 100%, right? So this measures the retracement. So if price decides, let's delete this one and this one. If price goes up to here, right, and then it starts retracing, if it only retraces 38.2%, bam, it's going to hit that level, right? And then price can go up from there. Or price may retrace to the 50% level, then go up. Or the 61.8, 78, the 86, or even 100% retracement, and then go up, right? And then this would be called something called a double bottom, right? So how do you know which retracement level price may retrace to? Well, you don't know for sure. But what you're going to use this as a confluence. You're going to, do your trend lines, your support and resistance, your supply and demand, right? Look at your structure, and you add this into the mix, right? This is part of our FAST method, right? FAST, F for Fibonacci, right? So if you have price retracing, and let's say it has that, and then it goes up, and price goes here, and then retraces down to right here, right? Let's delete this Fibonacci. So let's say price starts retracing, it gets down to here, and you learned about support and resistance, so you have a support line or a resistance line drawn here, and that became support. So price went up, broke our resistance, came down, made a support, right? So that's one confluence that, hey, price may reverse here. Then you pull out your fib tool, you measure from swing low to swing high, right? So you're measuring the impulse leg, swing low to swing high, measure it, and boom, it's about at the 50% mark. All right. So now you have two things. Hey, price may reverse at this point. We have a support and resistance line, and we have a 50% Fibonacci retracement. All right. And usually what happens is when price reverses off of a Fibonacci level, let me delete these for now. When price reverses off of a Fibonacci level, it usually will go to an extension. Now an extension is drawn here, and the way that I do that is I go into my settings, right? So I have all my Fibonacci levels selected here, 38.2, 50%, 61.8, or 61.8, all that. And then you go and you can make a negative 0.272 and a negative 0.618. And what those do is they measure extensions, right? So an extension is basically how far past the zero line is it. So this is 27.2% past this zero line. This is 61.8% past, right? So usually price will, if it reverses off of one of these levels, it will end up going to either the 27.2, or it may even continue all the way to 61.8. Usually price does that when it's trending, right? So if we were to measure the first leg before this second leg here happened, before all this happened, right? Let's say we measure price, comes up, right, reverses off of our 61.8, it starts moving up, right? We enter down here somewhere because we're expecting a lower high, right, or a higher low, and price starts moving up. So we enter long, we have a buy position. Where can we look to take our profits, right? So if we entered down here, where can we look to take our profits? Either here, at where we can look to take profits here at previous structure, which would be this previous high. So we can look to take off some profit there. We can look to take off some profit here at the negative 27.2, and we can look to take off some profit here, or close out our full position there. So as price moves up, you can either choose to hold your position as far as you think it's going to go. Obviously look for other support resistance levels up here, structure, other things that tell you, hey, price may stop at this point. But if you enter down here, price starts moving up, boom, you're in profit. You can take your profit off there, or you can take half of it off. It may go up to here, or it may even get all the way up to here. And then usually when it gets to this extension level, that's usually when it starts to make a retracement, right? And then once it makes a retracement, it's usually safer to trade with the trend. They say the trend is your friend until it ends, so trade with the trend. So if you're in an uptrend, yeah, the price is retracing, but you may not want to place a sell and try to trade it down because that movement is going to be a lot shorter and a lot less probable than price continuing to move upward. Okay, so that's how Fibonacci works. So let's go ahead and apply it to the charts and see how we're looking. Oh, and before that was all this was about, Fibonacci on an uptrend. What about a downtrend? How do you measure a downtrend? Remember I said it's the first point, then the second point. So in an uptrend, it's swing low to swing high because the swing low hits first. In a downtrend, first point is the swing high to swing low. And you measure it. And then you see, came up, hit the 618, went down, hit the 61.8% retracement, or negative 61.8 extension. Now I didn't draw that and know that it was going to hit those levels. It just so happens that because of the way our mind works and how our mind tends to like Fibonacci levels and things like that, when I drew this, it looked good to my eye. And the reason it looked good is because it actually matched up with these levels. And that's why Fibonacci works, is because somehow, because it happens naturally in nature, it's what naturally looks good to our eyes. So when we draw things, or if you look in architecture, if you look in the measurements of the things that we use every day, usually the things that look the most pleasurable to our eyes, usually line up with Fibonacci numbers and the golden ratio. And you can do more research on that online, of course. Just a little gee whiz info for you. All right, so let's apply it to the chart. Okay, so if you look here, if all this over here didn't happen yet, and you were just looking at the chart for what it is here, right? So if we had, let's say, a box here, and you didn't know what was going on, you didn't know that price was going to start retracing or anything like that. Let's see if I can fill it. All right. Might want to fill it with something that you can see, not see it. Okay. Okay, so here's price, right? And let's say we're watching price, and price decides, hey, I want to go down, right? So we're watching price, and what you want to look for is you want to look first for price to make a new low. Like, so at this point, you're trading uptrend. You're going to keep trying to trade an uptrend until price breaks its previous low. The previous low, if you look, we have it up. Let me make this different colors so you can see it better. So this kind of goes into structure as well, right? So structure, you have up, down. So this is your low. This is your high. Okay? And then when it comes down here, this is your higher low. And it comes up. You can consider this a higher high if you like. But I like to see significant retracements, right? So I would make this the next higher high right here. And then the next one here, this is our higher low. Then we have a higher high. So trading up this whole time, you're trading an uptrend, right? And at this point, before you see this retracement, you can be expecting a higher low and price to keep moving up. But that's actually not what happens. What actually happens is price goes down and it breaks our higher low. It violates us there. So now that is the first sign that price may be changing trend. Okay? So now we have instead of a higher low, we have a lower low. So now we can expect price to make a lower high somewhere. How do we know where price is going to make a lower high? Well, we can use structure, right? So we have a structure point. Right. Where is the one tool? This. So we have structure right here. little structure point there. And we have Fibonacci. So let's measure from our high, swing high to swing low, which is our major high and a major low right there. Right? And look what we have. Let me zoom in a little bit. We have price coming down. Delete this now. Coming down and retracing right to our 38.2 level, wicking off of that and starting to move down. As you see, and it moved down. So price reversed off of our 38%. It made a lower, a lower high, right? So we have a higher high, and then it made a lower low, and now we have a lower high. And we can expect price to start making a lower low. So price makes a lower low, comes down here. Makes a lower low, and now once price makes a lower low, what can you expect? It to make a lower high somewhere, right? Because we're in a downtrend. So pull out our Fibonacci again. And we're gonna sit there and watch, try to figure out where is price gonna reverse off of. Oh, look, it didn't retrace at all. There it goes. Now it starts retracing. So now our lower low is actually right here. All right, so now our lower low is here. So what we're gonna do is we're gonna bring this down. Now you see price starting to retrace up. Boom. So it retraced off of our 38.2%. Where can we expect it to go? To the 27 or the 61, right? Went to the 27, bounced off, made another lower high. So this would be a lower high here. Another lower low down here. And the lower high was right here. So measure from here down to here. Boom. Came up, hit our 61.8%. Came down to our negative 27% again. Made a lower low. That's not low. Alright. Measure from our swing high, swing low. And look, 100% retracement right there. This price has now made 100% retracement, but it didn't break it. It didn't break and close beyond it. Boom. What does it do? Goes back down. Where to? 27 again. See how price continuously retraces off of one of these levels and goes and hits negative 27% continuously. And this was a lower high also. This whole area was a lower high. So that's how Fibonacci works. All it does is give us extra confluence. You don't want to use Fibonacci, on its own. You want to use it as confluence. I mean, look at this. From this high to this low, we go up, boom. Hits our 61.8, comes back down to our negative 27. It works. You just have to know when to use it and use it in conjunction with other things. And so in the next video, we're going to be talking about structure in the terms of supply and demand, how to draw our supply zones, how to draw demand.